Hello and welcome, everyone. I'm Tom Bowley, Chief Market Strategist at earningsbeats.com, and this is Trading Places Live. It's Tuesday, December 14th, 2021, and I'm pre-recording this Trading Places Live for just a little bit later this morning. Currently, we do have futures down this morning. We got another inflation report that will be due out here in just a little bit. NASDAQ futures continue to take it a little bit harder than the S&P and the Dow. We've seen that of late as money seems to be disappearing from many of the growth names, although some of the bigger, larger cap growth names have done pretty well, like Apple and Microsoft. But once you get beyond that, the largest tier, there definitely has been a lot of weakness of late. So be looking to see that continue. I will say that December is the third month of the calendar quarter, and we do tend to see a little bit more movement away from the growth stocks when earnings season is not in play and when we're still just a little bit far away from the next earnings season. So this kind of is like a quiet period for many of the growth stocks. And as a result, that's when we do see, historically do tend to see some selling. So I think that's part of what's going on. I think also the inflation has been a scare again of late. And we got another PPI report coming out later this morning. So we'll see how that impacts the market. As far as the agenda for today, let's go ahead and run through that. I'm going to start off with the daily market recap. Then we'll get into talking technically. Going to look at retail today. Then jump into momentum sleepers, looking at the long-term momentum sleepers. These are a couple of areas of the market that have done really well over the long period. But just, last year, maybe even 2 years, not so much. And going to dig into those a little bit. Then we'll get into the earnings spotlight and wrap up with the three you must see. Before we get into any of that, let me take you over to earningsbeats.com. If you are new to us at Earnings Beats, welcome to the show. I'm glad to have you. Hopefully you'll enjoy some of the things that we talk about. But if you do want to learn more about us, I would suggest going over to our website at earningsbeats.com. And then just scrolling down, we have a free newsletter, Earnings Beats Digest. You can type in your name, email address. We'd love to have you join our newsletter. There's no credit card required. You can unsubscribe at any time. It's a newsletter that I publish 3 times a week, Mondays, Wednesdays, and Fridays, typically out by about 8:30 a.m. Eastern, so about an hour before the market opens. It's very, very simple read, usually just a couple of paragraphs and a chart. Sometimes it's a trading opportunity if you so desire. Of course, that's completely up to you. But for us, it's just teaching a little bit about some of the things that we look at and look for in terms of leading stocks and leading industry groups. And so that's some of the things that I would be maybe considering, if you want to learn more about us. Simply go to our website and then scroll down and you can type in your name, email address, and get started. All right, let's take a look at what happened on Monday. So daily market recap. Dow Jones Industrial Average down 320 points, S&P 500 down 43, NASDAQ down 217, mid caps down 29, small caps down 23. On a percentage basis, small caps got hit the hardest. You can see NASDAQ also had a pretty rough day, but really it was across the board. We just saw a lot of selling across the board. Strength came where you would expect when the market's weak, in defensive areas. Now, a lot of times what we'll see is all 11 sectors are down and defensive groups will just simply outperform on a relative basis. But we actually saw defensive groups going up. So this is definitely some rotation taking place here that's worth noting. Again, this could just be the December, third month in the calendar quarter kind of a thing, because this is when we do tend to see defensive groups outperform. But real estate moving up 1.34%, staples 1.31%, utilities 1.23%, and healthcare up almost 1%. So these 4 defensive groups having, what looks like a pretty bullish day on what was not a very bullish day. At the flip side, down at the bottom, energy down almost 3%, moving back below its moving averages. And one thing that I noticed yesterday too, that a few of the moving average or few of the major indices lost their moving averages, which to me is indicative of a more consolidatory period. Consolidatory, is that a word? Anyway, you can see the small caps moving sideways here. got some pretty good support, I would say around 1275 to 1300. We're still up around 1353. So I'm not really concerned from an intermediate standpoint. It's just more short term. You know, we're just, we've been struggling off of that November high. Same goes for the mid caps, but NASDAQ lost its 20-day, even though the S&P and the Dow did not. But I still view all of this as being in sideways consolidation mode or rectangular consolidation mode. The S&P 500, which actually did close at an all-time high on Friday, didn't set an intraday high, but did close at an all-time high. It was close enough to these other highs where if it pulls back, I would simply say this is sideways consolidation. So I'm not overly concerned about anything at this point. Just recognizing that the market is concerned about growth right now, inflation concerns. Also, seasonally, the December 10th to the December 15th period is the worst time of the month for U.S. equities during the month of December. December is a pretty good month. Not as good for growth stocks, though. It's more of the value stocks that do better in the month of December. But none of them do particularly well historically from the 10th to the 15th. It's really the second half of December where we tend to see most of our gains. So I would suspect, you know, maybe we do have a couple more days of this consolidation, pullback, and then let's see what happens as we start moving toward the holidays. Typically, the market gets in a much better mood, so we'll see. 10-year Treasury yield, currently 1.42%. You can see there finishing down 6.5 basis points yesterday, rolling over beneath the 20-day, which is now below the 50-day. So it's starting to give more signs of a downtrend. And I find this really interesting because you get a lot of headlines talking about inflation and how bad inflation is going to be. We've now been dealing this for a year, and yet the 10-year Treasury yield is really not that far. You know, really the inflation talk all began back in February. That's when we started getting some crazy high readings. And the 10-year Treasury yield has been flat throughout the whole thing. So if inflation is a big problem, you should see mass selling of treasuries, sending yields quite a bit higher, and we're not seeing that. So there's a lot of folks talking inflation, but I don't see the market walking the walk. I just hear the talk. So let's keep watching the signs, but I'm not seeing anything that suggests that the market, the bond market anyway, is overly concerned about inflation at this point. Let's move on to talking technically. So I wanted to talk first. Actually, we're going to get into that in just a minute. Let me go ahead and just pull up the XRT chart. So this is a widely diversified ETF. And it's a retail ETF, but there's no, you know, when you look at something like the sector ETFs and you look at the XLK and you think that you're looking at this huge barometer of the entire technology sector, you're really not. You're looking at about 10 stocks that make up about 70% of the ETF. So it's really the high octane, big growth stocks that drive the XLK. I mean, we're talking Apple and Microsoft, Google, and so forth. With the XRT, it's a very widely diversified retail ETF. I don't have all of the, I'll tell you what, though, I'm gonna see if I can find it just to give you a sense of how diversified this is. Just hang on one second. Let me see if I can find the components here and the leading components. All right, so on the holdings of the XRT, to give you some idea, the top 10 holdings, 11.49% make up, I mean, it makes up 11.49% of the total assets of the ETF, the top 10 holdings. So when you look at the top 10 holdings, you've got Etsy. The largest holding in the XRT is Etsy at 1.25%. Next up is Buckle, BKE, 1.23%. Revolve Group, RVLV, 1.21%. DoorDash, Dash is the ticker symbol, 1.17%. Boot Barn, which is Boot, 1.12%. I mean, you're getting the flavor. There's no one or two or three stocks that are driving the XRT. This is really a barometer of the entire, really the entire universe of retail stocks. So when I think retail and I just want to know what is the overall retail group doing, this is where I go. I go into the XRT. Tomorrow morning, we're going to get the next retail sales report. That is due out tomorrow morning, and the expectation is for October's retail sales increase of 1.7% to drop to the November increase of just 0.8%. So the increase is going to fall in half based on estimates. If we strip out the autos, essentially it's the same reading. October was 1.7% increase. We're expecting 0.9% increase for November. So we're expecting a drop off. Market's gone down a lot though. I mean, these retail stocks have dropped from about 104 middle of November down to 89 yesterday. So we haven't even gone a month, and we've seen probably about a 16% move to the downside. That's pretty significant. And I'm looking at some of these areas of support, and I'll just annotate this for you. So I guess the most recent low right here is the one right before we made this move up, and we just went down and tested this. Now we broke down below the prior low, which was early December, first trading day of September. And you can see when we bounced, we got no bounce in the PPO. PPO, so momentum, price momentum is still moving to the downside, even though price action went up for a couple of days. And then here comes the price action right back down again. So we're going to need a good report. And it almost seems like it may not even matter. Just seems like maybe the retail group needs to sell off here in the near term. If we get a good report, watch that 20-day moving average. If we can't get through it and we start rolling back over again, I think that's telling us that we want to be careful with retail as we go into the holidays. I'll give you a couple of other support levels. So here was one all the way back in May. That was a low. And then I would say probably the biggest one for me anyway is going to be the low back in March. And the reason that one's big is we took probably about 8 to 10 days worth of selling here. So in my opinion, this was probably the strongest selling that we saw throughout 2021. And that's where the buyers came back in. So I think if we weaken and we can't hold on to these other support levels, you're going to see a lot more panic set in. And I think at that point, probably would drive it down another 10% or so, or maybe a little less than 10%. So let's watch those levels. Now you might think, okay, well, it's retail and it's the holiday season, you know, shouldn't December be a good month? And if we pull up the seasonality on the XRT, now this is just the last 5 years, but you can see, you know, December's averaged going down the last 5 years. I'm going to go back to the last, let's just go to from 2013 to 2021. In 2013, that's when the S&P 500 broke out above the 2000 and 2007 highs. So that is where we got confirmation of a secular bull market. So a lot of times I'll look back and just see what the market's done since 2013. So since 2013, you can see September's been a rough month for retail, and December, along with, you know, some of these others. But I would say December has been probably, if not the worst, maybe the second worst group. It's the worst in terms of average percentage gain going back the last, you know, 8 years, back to 2013. So December has been a weak month historically, even though maybe common sense would tell us, hey, it's a month where there should be a lot of retail shoppers out. First of all, a lot of the retail shopping is done earlier in the year, so maybe you get a little bit of that pop earlier. But then the market tends to look ahead. And I think that's probably why we see the summertime months do better than the, you know, months where the actual holiday season resides. But after we get through the holiday season, you would think, okay, things are really going to, you know, probably back off. And yet January through April tends to be pretty strong. I mean, February and March are nothing special, but January is a strong month and April is a strong month. Over the last 8 years, these are the second and third strongest months. Only November has been stronger. So it's almost like it's backwards, heading into the Christmas holiday season. Doesn't seem to be a whole lot of movement to the upside in the XRT. Only goes up less than half of the years, half of the Decembers. And it does average losing ground. But then, it's still kind of 50-50 on whether it goes up. But when it does go up, it tends to move up very quickly in January. So that's just maybe a little something to keep in mind as we move forward. All right, so let's move on to momentum sleepers. Now, again, I wanted to look here at the longer term. So I've pulled up the defense group. Now, defense, this is going back the last 5 years. I mean, if you want to talk about long-term momentum sleeper here, this is like a poster child. I mean, the defense group is at 475, 474 and change right now. And back at the beginning of 2018, we're at the same level, 450, 475, right in here. The reason I call this momentum sleeper, long-term momentum sleeper, is let's look at that longer term chart. Now, this is a monthly chart. To me, the chart looks a lot different, doesn't it? I mean, here we went up almost unabated for 5 years, from 125 to 500. So, I mean, we went up 300% in 5 years. That's a lot. And usually when you get those kinds of moves, it requires more consolidation. And the fact that we did it over such a long period of time is why, in my opinion, I think we've got this long, term period of consolidation. Now, some of you might look at this and astutely point out that, hey, isn't this a head and shoulders? I mean, don't we have this long-term move to the upside, left shoulder, neckline, head, neckline, right shoulder? So that means we're going to come back down and break down. Well, I suppose it's possible. I mean, I think we're in a secular bull market. I think we go higher the next 10 years. So I'm not in the mood, or, my strategy isn't to try to find topping patterns where we're looking for a big move to the downside. If I was more bearish going forward, then yeah, I would look at this and try to point that out. But I think you have to kind of pick sides. And for me, I'm bullish. I think we've seen a lot of rotation. Last few years, the rotation has been away from defense. I think over the next 10 years, the rotation may very well be back into areas like defense. So I think this is in a period of consolidation, a long-term period of consolidation. But if inflation sticks with us for a while and growth isn't leading the market, we could see an area like defense start to pick up. We saw it earlier in 2021. We've gone sideways. I just wouldn't be asleep at the wheel here with defense stocks. It's been a while. I understand why, I'm a momentum trader. I have no interest in defense right now, but I do think it's important to continue to follow it, because we could see that leadership reemerge here. And right now, we're certainly not seeing that, but we could begin to see it again. So here was the daily chart, the 5-year. I'm going to shorten this back down now to 1 year and just take a look at some of the key areas. Obviously, the low that we just saw at the end of November, we want to watch that down at 450, a break below that. Then we're talking about moving back toward 52-week lows, not good. But watch the upside. We've got the 50-day moving average now sitting right above us, right near the prior high in November. So a close back up above, say, 480 would start to get my attention in the short term on defense stocks, especially, again, with money, kind of moving away right now from growth. It's going to be looking for other areas. And this is one that, could be, pretty good. The other thing I wanted to point out here, too, is on seasonality. The defense group. And if we look back over the last 10 years, looks like, December's not very good, but look at January and February, over the last decade. Seems like we're going into an area where the market, defense stocks tend to do pretty well. And if we compare to the S&P 500 over these last 10 years, I mean, you can see this is two months back to back, the strongest 2 months of the year back to back for defense. So yeah, we're not really doing anything in defense right now, but just keep in mind, we're going into a couple months where we tend to do pretty well. Watch that 480 level. A breakout might be a signal. All right. The other group that I wanted to talk about is financial administration stocks. I mean, look at this group. Talk about a lot of selling. I mean, this is a group that has not participated at all. In fact, it's been money coming out of this group that's helped to fuel a lot of other groups to the upside. So Wall Street has just tossed this area of the market to the side, and it's gone down with heavy volume too. This is not light volume. The AD line's gone down with price action. Just doesn't look very good. Now, let's step this out and let's go back and look 5 years like we did at defense. Now, what we see, I think, is a much different picture. Definitely, we got an uptrend in play. We went from the pandemic low at 400 to the July high of 950. We more than doubled in a little more than a year. Again, when you see that kind of movement to the upside, we shouldn't be shocked when we see pullbacks. Now, the question is this the low? Well, I mean, here, this bottom came with that PPO starting to show a V. This bottom clearly came with the PPO showing a V. And here we are with the PPO starting to turn higher. Now, we haven't broken back up above the 20-day. I think that would be a necessity for me to really start to think about this group. But I just want you to be aware that this is another group that's been struggling for a while. Not everything is Apple. Not everything is Microsoft going higher. You know, we tend to think, oh my gosh, the S&P's at a 500's at an all-time high. You know, we can't buy anything. There's still a lot of stocks in a lot of areas of the market not participating. And we have to keep that in mind because rotation is what drives secular bull markets. So as other areas that have been in favor start to lose their luster, areas like financial administration and defense, which have been underperforming wildly, could begin to regain some of that strength. I mean, look how bad they look. This group looked in the fourth quarter of 2018. And then all of a sudden, out of nowhere, there we go. 2020, the pandemic. You know, this was a group that was hit hard along with a lot of different groups, but came roaring back. And now here we are again, finding ourselves in this position. I believe this is a group that bounces back. Does it bounce back right from here? I don't know. I wish I had, you know, the crystal ball, but I do believe it'll bounce back. Got a bunch of bottoms down here around 675 or so, 670. So if we were to pull back, we might see a positive divergence form. So that might be a level to the downside that you might start to nibble. And then to the upside, watch that 20-day EMA. I think that's going to be the key area. All right. Got a few earnings reports coming up later this week. Not a lot, but we got a few. So I thought what we would do is just kind of go through a few of these and just see if any of them stand out as being, you know, outperformers. See if Wall Street's telling us anything. So the first one, Lennar Home Building. Home building's been pretty good. Lennar has not been very good among its home building peers, though. So that makes me a little nervous and would probably have me on the sidelines, maybe just wanting to see how Lennar reports and go from there. Hyco Corp, this is an aerospace company. Now, this one's a little different in that the group is not performing well, but Hyco's been a very strong performer relative to the aerospace group. So I'm not sure what to make of this one. I can say this, though. Wall Street is favoring this company in the group. So if you're a fan of the group, you really want to see a strong report here. And to me, what I would like to see is a strong report and a breakout and an open above 150 when they report. And they will be reporting on Wednesday, by the way. Let's see. On Thursday, we've got Adobe Systems reporting. So back into the software space. And I can tell you some of these software names and some of the growth names have not been doing well of late. Adobe has been trending higher. AD line kind of flat coming across here. Software, of course, was doing well into November, but it has pulled back quite a bit. Adobe's just kind of been going along for the ride. We've had periods, pockets of relative strength, and then pockets of not so good action, relative weakness. But overall, we're right about in the middle where we've been all year. So it's been an okay performer. This would give a boost to the group, I think, if Adobe could come out as a leader and post some nice numbers and get through 700. So that's what I would be looking for there. Again, I'm not seeing anything that really is telling me Wall Street is looking for a massive report here. So let's look at maybe another one or two. ACN, Accenture, AD line going kind of sideways, but not bad. Price action moving to a new 52-week high relative to the software group, Accenture at a 52-week high. So this is one that Wall Street is favoring, and this is one I'd expect a big report out of. So ACN, if you want to see continuing strength in software, I think this is a stock I'd be watching. One other stock we'll look at, FedEx. FedEx will be reporting on Thursday, along with both Accenture and Adobe Systems. FedEx, however, has been trending down. Its AD line has been weak. The group itself has been weak, and FedEx relative to the group has been weak. I would not be expecting a big report out of FedEx based on what I'm seeing here. So you got some issues with a few of these companies that are going to be reporting earnings. I'm not seeing a lot of strength here, with the one exception being Accenture. That's one that I think here over the next couple of days has an opportunity maybe to report some pretty strong numbers based on the way that it's been performing heading into earnings. And I think a lot of that's dictated by Wall Street and their meetings with these companies' management teams. So let's kind of keep an eye out for that. But ACN, I would think on Thursday, is the one that I would be interested in terms of feeling pretty confident going into the report that we're going to have a strong report. And that doesn't always mean you're going to have a strong reaction. You got to separate the two. But if you have a company that looks really good and they deliver the goods and then they pull back with earnings, I think that's a great opportunity to enter. So I don't mind if a company pulls back, even with strong results. I think that gives us opportunities to jump into a stock like that. All right, let's move on to the three you must see to wrap this thing up. I'm going to start off with General Motors. I'm going to do the three worst performers on the S&P 500 yesterday and just give you some thoughts. GM is in an auto group. The auto group, you can see down here at the bottom, has been underperforming since the beginning of November. I think that's part of what's going on here with GM. GM also has just been sideways consolidating, needs to break out above 64, 65. Until we get that, I think it's more of a hold or even a sell. I like Tesla better, and I like Ford better. NVIDIA. NVIDIA finally is giving up a little bit. And, it's hard to ever gauge when a really strong large cap growth name is going to pull back. Well, it's pulling back. NVIDIA printed that bearish engulfing candle right at the top, just above the 340 level, and it's been selling off since. It's now down to 280. I would watch the 50-day moving average, maybe watch the trend line coming in here. If the market's really weak, if growth continues to be thrown out, back behind the woodshed, I probably would expect at least a 50-day test and possibly even a trip down to about 240 or so. I still love NVIDIA long-term. I think that would be a great opportunity for entry from a trading perspective. But, you got to recognize how far some of these stocks have come up. And the last one I have for you is Align Technology, ALGN. This one hasn't been a great performer throughout the year. The one thing I do like is that the AD line is still staying pretty strong. So as long as it can hold on to this support around 580, I give it a decent chance to go back up here to challenge 740 and maybe even break out again. But on a relative basis, you can see it's been up and down versus the medical supplies. Medical supplies hasn't been very strong. I'd like to see that group come back. Healthcare is trying to make a breakout, by the way, the XLV, if you look at that on a chart. So if you get that and we start seeing a little bit more rotation into the group, perhaps that's what will help Align. But it is a growth story, so that's part of the problem here. Watch 580. All right, that's it for me. I appreciate everybody tuning in. Listen, have a great Tuesday. I'll be back on Wednesday over at earningsbeats.com for your next Trading Places Live. That'll start at 9 a.m. Eastern on Wednesday. Have a great day, everybody. Happy trading.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.